For decades, silver was treated like the quiet cousin of gold. It sat in the background, ignored by policymakers, dismissed by analysts, and overshadowed by flashier assets. Yet today, silver shortages are spreading faster than oil shocks ever did, and almost nobody in the mainstream is explaining why. This is not a story about speculation or hype. This is a story about physics, industrial necessity, and financial structure colliding at the same time. Every modern economy runs on energy, and energy runs on materials. Oil once sat at the center of that equation because transportation, manufacturing, and geopolitics all depended on it. But silver has quietly become just as essential, if not more so, because it sits inside nearly every system that makes modern life function. Solar panels, electric vehicles, data centers, medical imaging, water purification, satellites, advanced weapons systems, and telecommunications all rely on silver's unmatched electrical and thermal conductivity. There is no substitute that performs at the same level without serious efficiency losses. What makes the current silver shortage different from previous commodity squeezes is speed. Oil shocks typically unfold over months or years, triggered by wars, embargoes, or production cuts. Silver shortages, by contrast, are spreading through supply chains almost invisibly and accelerating week by week. Manufacturers are discovering delays, not because prices spiked overnight, but because the metal simply is not available in the quantities they need. The global silver market operates on an assumption that has now broken. For years, paper contracts, futures, and unallocated accounts created the illusion of abundance. On screens, silver looked plentiful. In vaults, it was disappearing. Industrial demand has been consuming silver at a rate that mine supply cannot match, and this gap has widened quietly every single year. Mining output has barely moved. Silver production is constrained by geology, not price. Most silver is produced as a byproduct of copper, lead, and zinc mining. Even if silver prices double, miners cannot simply flip a switch and produce more. New mines take many years to permit, finance, and build. Meanwhile, industrial demand does not wait. Solar panel factories, electric vehicle plants, and semiconductor manufacturers operate on fixed timelines. They must secure silver regardless of cost, because their entire production process depends on it. This is where the oil comparison becomes critical. When oil prices rise, demand can be rationed. People drive less. Airlines cut routes. Alternatives appear. Silver does not offer that flexibility. When a data center needs silver for servers and cooling systems, it cannot simply choose another metal without redesigning the entire architecture. When a solar panel manufacturer needs silver paste for photovoltaic cells, there is no economically viable replacement at scale. The result is a structural shortage, not a cyclical one. And structural shortages behave very differently. They do not resolve quickly. They do not respond smoothly to price signals. Instead, they tighten suddenly and then cascade across industries. What few people realize is that silver inventories were already thin before this acceleration began. For years, above-ground silver stocks were drawn down to cover deficits between supply and demand. Governments sold reserves. Vaults emptied. Industrial stockpiles shrank. This worked only because prices remained artificially calm and paper markets masked the underlying imbalance. Now that calm is breaking. Delivery times are stretching. Lease rates are rising. Refiners are paying premiums. These are not signals of speculation. They are signals of physical stress. At the same time, governments have quietly reclassified silver. When a material is labeled critical, it is an admission that national infrastructure depends on it. This designation places silver alongside materials like lithium and rare earths, signaling that supply security now outweighs free market pricing. Once a metal enters this category, policy tools come into play, including stockpiling, export controls, and strategic prioritization. This is where shortages begin to spread faster than oil shocks. Oil shortages tend to remain localized at first, affecting fuel prices and transportation. Silver shortages ripple through technology, energy, healthcare, and defense simultaneously. A delay in silver delivery does not just slow one sector. It slows many, all at once. And unlike oil, silver gets consumed permanently. Oil is burned once. Silver is embedded into products that may never be recycled. Solar panels installed today will sit on rooftops for decades. Electronics end up in landfills. Medical equipment is discarded. Each ounce that enters industrial use is effectively removed from circulation. This means every year starts with less available silver than the year before. Demand grows, Supply stagnates. Inventories shrink. This is not a theory. It is arithmetic. Financial markets are only beginning to recognize this reality. For years, silver traded like a financial asset, reacting to interest rates and currency moves. Now it is reverting to what it truly is, an industrial lifeline. And when lifelines begin to fray, panic does not announce itself loudly at first. It shows up as delays, shortages, and quiet bidding wars behind closed doors. That is why silver shortages are spreading faster than oil shocks. They are not driven by headlines. They are driven by necessity. And necessity does not negotiate. As physical silver tightens, the financial structure built around it is starting to reveal deep fractures. For decades, the silver market functioned on leverage. Multiple claims existed on the same ounce. Futures contracts promised delivery that almost never occurred. Exchange-traded products allowed investors to believe they owned silver without ever touching it. This worked only because most participants never asked for the metal. Industrial users are now asking for the metal. When physical demand collides with a paper-heavy system, stress appears quickly. Lease rates, which measure the cost of borrowing silver for short periods, are one of the earliest warning signs. When lease rates rise sharply, it signals that holders of silver are reluctant to part with it, even temporarily. They understand its value is increasing not because of speculation, but because of scarcity. This is where the oil comparison breaks down again. Oil markets are built around delivery. Tankers move. Storage is visible. Inventories are reported. Silver markets, by contrast, are opaque. Vault data is fragmented. Custodians overlap. One institution can hold metal on behalf of multiple products simultaneously. This opacity allows shortages to grow unnoticed until they become severe. Large financial institutions understand this structure better than anyone. They know that when shortages emerge, paper holders are last in line. Physical owners control the outcome. This is why institutional behavior has shifted so dramatically. Instead of trading silver contracts, major players have been accumulating actual bars. Not because they expect a quick trade, but because they see a strategic imbalance forming. History offers a clear lesson. Attempts to control silver through paper have always failed. The market eventually demands delivery. When that moment arrives, rules change, not to protect participants, but to preserve the system. Those who hold physical metal remain insulated. Those who hold promises discover the limits of those promises. Industrial demand is relentless. Solar capacity continues expanding globally as governments push energy transitions. Electric vehicles require more silver per unit than internal combustion vehicles. Data centers, driven by artificial intelligence workloads, are being built at a pace never seen before. Each server rack contains silver. Each cooling system relies on it. Each connection depends on it. Medical demand is also rising. Silver's antimicrobial properties make it essential in medical devices, wound care, and water purification. These uses are not optional. They are regulated. Hospitals cannot simply reduce silver usage to save costs. Defense demand adds another layer. Modern weapon systems, guidance technology, and secure communications all rely on silver. Governments do not compete on price. They secure supply. When strategic demand enters a market, price becomes secondary to availability. This creates a hierarchy of buyers. At the top are governments and critical industries that will pay almost any price. Below them are investors. At the bottom are paper holders whose claims depend on smooth market functioning. When shortages intensify, priority shifts upward rapidly. What makes this moment particularly dangerous for the existing system is timing. Monetary policy is adding fuel to the fire. When central banks expand liquidity, real assets benefit. More currency units chase the same finite resources. In past cycles, gold responded first. Silver followed later. This time, silver's industrial role compresses the timeline. Price signals move faster because physical demand is immediate. The result is a feedback loop. Higher prices signal scarcity. Scarcity encourages hoarding. Hoarding tightens supply further. Industrial buyers accelerate purchases to avoid future shortages. This dynamic spreads across borders quickly because supply chains are global. Oil shocks often begin in one region. Silver shortages begin everywhere at once. A solar factory in Asia, a data center in North America, and a medical supplier in Europe all draw from the same limited pool. When one buyer secures supply, another is forced to scramble. This is already happening quietly. Long-term supply contracts are being renegotiated. Refiners are prioritizing certain clients. Smaller buyers are being pushed out. These are early-stage rationing mechanisms. And yet, public awareness remains low. Silver does not dominate headlines the way oil does. Gasoline prices hit consumers directly. Silver shortages manifest indirectly through higher costs, delays, and reduced availability of technology. By the time consumers feel it, the underlying metal is already gone. The most dangerous assumption investors can make right now is believing that silver markets will function normally under stress. History suggests otherwise. When systems built on leverage encounter physical constraints, they protect the core institutions first. Access, not ownership, determines outcomes. This is why the current silver shortage is not merely a commodity story. It is a structural test of how modern markets handle scarcity. And the answer, increasingly, is that they do not handle it evenly. As silver shortages deepen, the consequences will not unfold in a straight line. They will appear in bursts. One sector will experience delays. Another will announce cost overruns. Another will quietly secure long-term supply at prices that shock the market months later. By the time prices reflect reality, the metal will already be locked away. This is where oil shocks offer a final contrast. Oil crises are visible. Tanker routes change. Strategic reserves are released. Governments hold press conferences. Silver shortages operate in silence. There is no strategic silver reserve release that calms markets. There is only competition for dwindling supply. The financial implications are profound. Silver has long been undervalued relative to its importance. Its price never reflected its role as an industrial keystone. That mismatch is now correcting, not gradually, but structurally. When a material becomes indispensable, price becomes a function of necessity, not sentiment. Industrial buyers do not care about charts. They care about continuity. They will secure supply even if it means paying multiples of past prices. This sets new reference points. Once contracts are signed at higher levels, those prices do not revert easily. They become the new baseline. At the same time, investors holding silver as insurance against monetary instability are beginning to overlap with industrial demand. This convergence is rare. It means silver is being pulled from both sides as a hedge and as a consumable. Few assets experience this dual pressure simultaneously. Recycling will increase, but it cannot close the gap quickly. Recovering silver from electronics is expensive and slow. Infrastructure is limited. Even aggressive recycling efforts lag years behind demand growth. Recycling responds to price, but with delay. Meanwhile, substitution remains largely theoretical. Research into alternative materials continues, but performance losses remain significant. In high-efficiency systems, even small conductivity losses translate into major energy waste. For industries under regulatory pressure to reduce emissions, efficiency matters more than material cost. This locks silver into place. It cannot be easily replaced. It cannot be quickly produced. It cannot be painlessly recycled. And it is being consumed permanently. Markets eventually price these realities in. When they do, the adjustment is rarely smooth. It tends to overshoot because fear replaces complacency. Buyers rush, sellers vanish. Liquidity dries up. This is how shortages turn into shocks. For years, silver was treated as an afterthought, a monetary metal without monetary respect, an industrial metal without industrial urgency. That era is ending. Silver is being reclassified by reality itself. The spread of silver shortages faster than oil shocks is not an anomaly. It is a consequence of modern complexity. Our world is more electrified, more connected, and more technologically dependent than ever before. All of that dependence funnels back to a small set of materials. Silver sits at the center of that funnel. When oil shocks hit, societies adapt by conserving. When silver shortages hit, adaptation is harder. You cannot conserve connectivity. You cannot delay infrastructure indefinitely. You cannot power a digital economy without its core materials. This is why the coming period will redefine how silver is viewed. Not as a speculative trade. Not as a relic of old monetary systems, but as a strategic resource whose availability determines economic stability. Those who understand this early focus on access and ownership rather than price predictions. They recognize that in a shortage, the question is not how much something costs, but whether it can be obtained at all. The quiet nature of the silver market has delayed this realization. But quiet does not mean unimportant. It often means underestimated. As shortages spread, they will expose the assumptions embedded in financial products, supply chains, and policy frameworks. Some of those assumptions will fail. Others will be rewritten. Silver is no longer waiting for attention. It is forcing it, and unlike oil, which announces its crisis loudly, silver is reshaping the system silently, ounce by ounce, contract by contract, until the imbalance becomes impossible to ignore. By the time the world reacts openly, the shortage will already be entrenched, and the speed at which it spreads will make oil shocks look slow by comparison.